Hey everyone, welcome back to the channel. This is LC. I will do a quick introduction about financial instruments you can always find in financial statements. Rather than just introducing them by going through their standard definitions where you can find easily in Google, I will use scenario approach to explain concept of different type of financial instruments. In general, there are 4 different types of financial instruments. First, held to maturity. Second, held for trading. Third, available for sale. The fourth one is derivatives. We will focus on held to maturity, held for trading, available for sale in this video. Derivatives will be covered in the future. For each financial instrument, we will take one scenario for learning. In each scenario, we will answer 3 questions. We start with scenario A. If Company A purchases 500 shares in Company B for $10 each, Company A plans to sell the shares for a quick gain. It means Company A will sell the shares for profit or loss in short term, most likely within 12 months. First question, what type of assets should Company A classify on the balance sheet? Held for trading, available for sale, held to maturity. You can pause this video for 1 minute to answer. The answer is held for trading or trading securities or short-term investments. Question 2. If Company B's share price increases to $11, what should Company A record on its income statement and cash flow statement? You can pause this video for 1 minute to answer. Here is the answer. In income statement, Company A will record $500 unrealized gains or losses. Company A will record negative $500 for unrealized gain, which is a non-cash item to be reversed in cash flow statement. Question 3. If Company A sells Company B's shares at $11, what should Company A record on its income statement and cash flow statement? Pause this video for 1 minute to answer. The answer is Company A will record realized gains of $500 in the income statement. In summary, held for trading is used for a lot of stocks and bonds where a company buys something and then intends to sell it shortly thereafter. This kind of financial instrument is definitely not for hedging. These are pretty much always short-term investments on the balance sheet. We record these financial instruments at fair market value. The next scenario, scenario 2. Company A purchases 500 shares of Company B for $10 each, but Company A plans not to sell the shares soon or has no idea when to sell the shares. Question 1. What type of asset should Company A classify on the balance sheet? Held for trading, available for sale, held to maturity. Pause this video for 1 minute to answer. The answer is available for sale securities on its balance sheet. Question 2. If Company B's share price increases to $11 and Company A has not yet sold anything, what happened to income statement, cash flow statement, and balance sheet? You can pause this video for 1 minute to answer. The answer is a bit long. For this case, income statement, no changes, but you will see unrealized gains or losses in other comprehensive income. Cash flow statement, no changes. Balance sheet, you will see long-term investments are up by $500 and other comprehensive income on the liabilities and equity side will increase $500. You may wonder how the numbers are reflected in other comprehensive income. Net change in fair value of available for sale investment. This is equivalent to unrealized gains or losses. Realization on fair value of available for sale investments means disposal of available for sale investments at market value, but yet to transfer to P&L. To view the details of unrealized gains and loss, you must navigate to footnote. Question 3. If Company A sells Company B's shares at $11, what would Company A record on its income statement and cash flow statement? Pause this video for 1 minute to answer. The answer is Company A will record $500 of realized gains in the income statement. Available for sale is sort of the default category for everything else that doesn't fit into one of the other categories. You see this used a lot for stocks and bonds. It is used when a company doesn't really know what it's going to do with it or what is its plan for selling them off is. So, if it doesn't know it is going to sell them in a year or 2 years or next month or something like that, it will often show in available for sale securities. Now, this can be technically short-term investments, but usually they are classified as long-term investments because the time frame is indefinite, so they are soon to be somewhat longer-term items. Scenario 3. Company A buys $500 of Company B's 10-year bonds and plans to hold them until the bonds mature in 10 years. Question 1. What type of asset should Company A classify on the balance sheet? Well, this is pretty straightforward. The answer is held to maturity. Question 2. If the fair market value of these bonds increases from $100 to $110, what should Company A record on its income statement and cash flow statement? Pause this video for 1 minute to answer. The answer is nothing changes. Unrealized gains and losses are not reported at all with held to maturity securities. If you hold a bond in a company and you plan to hold it for 10 years until it matures completely and it pays back, even if the market value of that bond goes up or down because of changes in interest rates, for example, you are not going to report any of that on the financial statements. Question 3. Upon maturity of the bond, if Company A were to sell these bonds at $550, what should Company A record on its income statement? Pause this video for 1 minute to answer. Company A will record a realized gain of $50 on the income statement and make it flow through the rest of the statements. So, in summary, with bonds, they have a maturity date. That has to be repaid on a certain schedule, and the entire remaining balance has to be repaid at a certain point in time. So this is mostly used for bonds, and these are pretty much all under long-term investments. The accounting method here is amortized cost. If you have a long-term debt of $100, you repay $90. Now you list it as 90 on the balance sheet. So it's just a fancy way of saying that, but that's the official accounting term. If you enjoyed the video, give me a like and share it out. If you didn't, a dislike. Subscribe for more, ring the bell, and I will see you in the next one.